Understanding pyramid schemes, risks, mechanics, and legal implications. Pyramid schemes are often confused with legitimate business models, particularly multi-level marketing, MLM, organizations, which can lead to financial loss and legal consequences. This article aims to clarify what pyramid schemes are, how they function, and the differences between them and legitimate MLMs. What is a pyramid scheme? A pyramid scheme is a fraudulent investment model that promises high returns with little effort, often under the guise of selling a product or service. The core of this scheme is simple: money from new investors is used to pay returns to earlier investors. This structure creates the illusion of profitability while being fundamentally unsustainable. Eventually, the scheme collapses when it can no longer recruit new investors, leaving the majority of participants at a loss. How pyramid schemes operate. At the apex of a pyramid scheme is the founder, let's call him Mike. Mike recruits several individuals, who in turn recruit even more individuals, creating a cascading effect where each level draws money from the levels below. 1. Initial recruitment. Mike recruits 10 people, each of whom pays an initiation fee. 2. Explosive growth. Those 10 then recruit another 10 each, resulting in 100 more participants. 3. Money flow. Each new member pays a fee that is distributed up the pyramid to earlier members, often with a percentage going to Mike. With each new layer, the pyramid expands, creating a flow of money upwards, but relying primarily on recruitment rather than the sale of actual goods or services. Participants are often led to believe they will profit significantly, but once recruitment stagnates, the pyramid collapses, leaving most participants with nothing. Characteristics of pyramid schemes. According to the U.S. Securities and Exchange Commission, SEC, investors should be wary of the following features that typically characterize pyramid schemes. Lack of genuine products or services. There is often little to no actual retail sale of goods or services. Promises of high returns. Those involved usually are lured by exaggerated returns in short time frames. Focus on recruitment. The emphasis is on bringing in new members rather than selling products. Complex commission structures. The payment mechanisms can be convoluted to obscure the lack of legitimate business operations. Legal status and consequences. In the United States, pyramid schemes are illegal and deemed a felony. Recruiting individuals into a pyramid scheme can result in serious consequences, including hefty fines, up to $5,000, and imprisonment for up to 4 years. Pyramid schemes can strain personal relationships, often pressuring participants to recruit friends and family, creating an environment of mistrust and discomfort. Types of pyramid schemes. Pyramid schemes can take various forms, including 1. Multi-level marketing, MLM, programs. Legitimate MLMs involve selling real products or services. Distributors earn income not only from their own sales but also from the sales made by recruits. However, some MLMs may possess pyramid-like characteristics. Emphasizing recruitment over sales. Making outlandish claims regarding earning potential. Forcing participants to purchase products they cannot sell to qualify for rewards. 2. Chain emails. Chain email schemes ask recipients to donate money to individuals listed in an email. Participants delete the first name, add theirs, and forward the email with the hope of receiving donations from those they recruit. These lack sustainability as well and resemble pyramid structures. 3. Ponzi schemes. Not to be confused, Ponzi schemes don't structurally resemble pyramids but share the same fraudulent nature. They promise high returns, relying on money from new investors rather than profits from legitimate business activities. The infamous case of Bernie Madoff, who operated a multi-billion-dollar Ponzi scheme, exemplifies the catastrophic fallout from such schemes for individuals and the broader community. The collapse of pyramid schemes. Pyramid schemes wind down when recruitment dries up. With fewer participants to funnel money upwards, the financial structure crumbles. Despite some investors potentially seeing returns in the early stages, most will ultimately face financial losses. Conclusion: pyramid schemes are a perilous investment trap. Understanding their mechanics and recognizing their characteristics can empower individuals to avoid becoming victims. The legal ramifications of participating in or recruiting for such schemes could lead not just to financial ruin but also to legal challenges that could jeopardize one's future. As a general rule, if an investment opportunity seems too good to be true and emphasizes recruitment over genuine product sales, it's best to steer clear. Additional resources: Federal Trade Commission, FTC, a great source for understanding the differences between legitimate MLM and illegal pyramid schemes. Securities and Exchange Commission, SEC, provides insights into various investment scams, including pyramid schemes and their legal implications. Consumer Financial Protection Bureau, CFPB, offers tips and resources for recognizing and protecting oneself from investment fraud. By staying informed and skeptical of investment opportunities, individuals can protect themselves and their finances from the pitfalls of pyramid schemes.